The headlines tell you the economy is booming. They point to numbers showing strong growth and a resilient consumer. But if you're looking for a job, paying your bills, or just trying to get by, you're probably feeling something very different. And it's not just in your head. That feeling that things are off, that the official story doesn't match your reality, is real. There is a great economic disconnect happening right now, and it's one of the most significant and confusing paradoxes in our modern economy. The numbers say one thing, but the reality on the ground for millions of people feels completely different. In this video, we're going to investigate this strange paradox. We'll break down the official story, and then we'll dig into the data that tells the real story. We'll uncover who is actually winning in this confusing market and expose exactly why it feels like so many of us are being left behind. This is the story of the great economic disconnect, and it affects every single one of us. To understand the disconnect, you first have to understand the official story. And that story is built around one big, impressive sounding number. Gross domestic product, or GDP. GDP is meant to be the ultimate report card for the economy. It's a measure of all the goods and services produced and sold. When GDP goes up, we're told the economy is growing and that things are getting better. And on the surface, the GDP numbers for 2025 look pretty decent. After a slight contraction in the first quarter of 2025, where the economy shrank by 0.6%, it came roaring back. The second quarter saw a huge rebound, with the economy expanding at an annualized rate of 3.8%. And the latest estimates for the third quarter from the Atlanta Fed's GDP Now model point to continued strong growth, somewhere around 3.5%. All told, forecasters expect the US economy to grow somewhere around 1.7% to 1.9% for the full year of 2025, a picture of steady, if not spectacular, expansion. When you pair that with the headline unemployment number, the picture looks even rosier. The official unemployment rate has been hovering in the low 4% range. For much of 2025, it's been around 4.4%. In a historical context, these are very low numbers. Economists traditionally consider anything under 5% to be close to full employment. So the official narrative is clear. The economy is growing at a healthy clip, and nearly everyone who wants a job has one. But that's where the story starts to fall apart, because for millions, that narrative feels like a fantasy. It doesn't square with the lived experience of watching grocery and gas prices stay stubbornly high, of seeing friends and family struggle to find work, or of feeling that financial security is further away than ever. The anxiety is palpable, and it's rooted in a reality that these headline numbers completely miss. Let's start with inflation. While it has cooled from the staggering peaks we saw a couple of years ago, it's still nibbling away at your wallet. As of September 2025, the annual inflation rate was still running at 3.0%. The Federal Reserve's preferred measure, the Personal Consumption Expenditures or PCE price index, was also showing persistent price pressures. While not the crisis level inflation of 2022, this elevated cost of living grinds people down. It means that even if your wages go up slightly, your purchasing power is being eroded month after month. The cost of essentials like food and shelter remains a major burden. This feeling is the first crack in the official story. Growth is great, but what does it mean if your paycheck buys you less? A low unemployment rate sounds wonderful, but what if the jobs being created are precarious, low paying, or not in your field? This is the core of the great disconnect, a widening chasm between the macro level economic data that gets reported on the news and the micro level reality that households experience every day. The official story talks about percentages and annualized rates. Your reality is about your bank account, your job prospects, and your ability to plan for the future. And right now, those two stories are telling completely different tales. In the next section, we'll look at the biggest and most jarring piece of this puzzle, the hiring paradox. This is where the disconnect becomes undeniable. The official story of a strong economy simply cannot be reconciled with what is happening in the American labor market. On one hand, you have a low unemployment rate. On the other hand, hiring has slowed dramatically, and in some areas, it has reversed. Let's look at the numbers. The Bureau of Labor Statistics, the official source, showed that job growth weakened throughout the year, while September 2025 saw a respectable gain of 119,000 jobs that followed in August, where job numbers were revised to show a net loss. But here's where we need to look at the alternative metrics, the data that often gives a clearer, faster picture than the official government reports. The ADP National Employment Report, which is based on the actual payroll data of over 26 million private sector employees, paints an even starker picture. In November of 2025, the ADP report sent shockwaves through the market. It reported that the private sector didn't just see slow job growth, it actually lost 32,000 jobs. This wasn't a blip, it was a confirmation of a trend that had been building. Job creation, according to ADP, has been essentially flat for the entire second half of 2025. The chief economist at ADP, Nayla Richardson, put it bluntly: hiring has been choppy of late as employers weather cautious consumers and an uncertain macroeconomic environment. The weakness was broad based. Manufacturing lost 18,000 jobs, the information sector lost 20,000, and professional and business services lost 26,000 jobs. Most troubling of all was where the pain was concentrated: small businesses. According to ADP data, companies with fewer than 50 employees shed a staggering 120,000 jobs in November alone. These small businesses are the backbone of the American economy, and they are pulling back hard. So, how can the official unemployment rate be so low if hiring is this weak? This is the paradox, and there are a few key explanations. First, we have to look beyond the headline number. The official unemployment rate, known as the U3 rate, is notoriously narrow. It only counts people who are jobless, have actively looked for work in the past 4 weeks, and are available for work. It doesn't count the people who are so discouraged they've stopped looking, or those working part time because they can't find a full time job. For that, we have to look at a broader measure called the U6 rate. This is often called the real unemployment rate. In September 2025, while the official U3 rate was 4.4%, the U6 rate was 8.0%. An 8% unemployment rate tells a very different story than a 4.4% rate. It's a story of an economy with significant slack and a lot more people struggling than the headlines let on. Second, the low unemployment rate is being propped up by a slower growing labor force. Fewer people entering the workforce means you need to create fewer jobs just to keep the unemployment rate stable. Some of this is due to demographic shifts, but policy changes around immigration have also played a role in reducing the available labor supply. This creates a statistical illusion. The unemployment rate can stay low, not just because people are getting hired, but because the pool of available workers isn't growing as fast as it used to. Finally, the jobs that are being created are heavily concentrated in just a few sectors. In September, the economy added 119,000 jobs, but healthcare and social assistance accounted for a huge chunk of that. Meanwhile, areas like manufacturing, transportation, and warehousing saw job losses. This creates a brutal job market for many, especially young people and recent college graduates. They aren't looking for jobs in healthcare. They're looking for roles in tech, media, consulting, and business, exactly the sectors that are now shedding jobs. They are entering an economy that on paper looks great, only to find that the opportunities in their chosen fields are vanishing. This is the hiring paradox. It's a tale of two job markets: one where a few sectors are still adding workers, keeping the headline numbers afloat, and another, much larger market where hiring has frozen. The official story celebrates a 4.4% unemployment rate, but the reality is a U6 rate of 8%, private sector job losses, and a brutal landscape for anyone trying to build a career. So if companies aren't hiring, where is all that growth from the GDP numbers actually going? So we have our central mystery. GDP is going up, but hiring is going down. This seems to violate the basic laws of economics. How can a company be producing and selling more without needing more people to do the work? The answer to that question reveals who is truly benefiting in this strange new economy. The money isn't disappearing, it's being redirected. And it's being redirected in massive amounts to corporate profits. The story of the post pandemic economy is, more than anything, a story of corporate profitability remaining at historically high levels. While many workers have struggled with inflation that outpaces their wage gains, corporations have managed to protect their profit margins. Data from the Bureau of Economic Analysis tells the story. Corporate profits as a share of the national income remain significantly larger than they were in the decades before 2020. This isn't a small uptick. It's a fundamental shift in how the gains from economic activity are being distributed. The share going to labor in the form of wages and salaries has lagged, while the share going to capital in the form of corporate profits has held strong near record highs. This isn't a partisan talking point, it's a statistical fact. In the second quarter of 2025, corporate profits from current production saw another slight increase, even as the job market was clearly softening. So, what are companies doing with all this cash? The classic economic model suggests they would reinvest it, spend it on new factories, R&D, and most importantly, hiring more workers. But that's not what's happening across the board. Instead of using all these profits to invest in growth and labor, a huge portion is being funneled directly back to shareholders. This happens in two main ways: dividends and stock buybacks. Dividends are simple, direct cash payments to shareholders. Stock buybacks are a bit more complex, but their effect is largely the same. A company uses its cash to buy its own shares off the open market. This reduces the number of shares available, which automatically increases the earnings per share, makes the stock look more attractive, and almost always drives the stock price up. In recent years, stock buybacks have exploded, becoming a preferred way for major corporations to reward investors. For the people who own stock, top executives with stock based compensation, and the wealthy households that own the vast majority of equities, this is fantastic news. Their net worth grows, but for the health of the broader economy, it's a very different story. This helps create growth without prosperity. It's a way for a company's financial value to increase without the company actually expanding its real world operations, hiring more people, or producing substantially more goods. This helps explain the paradox of rising GDP and slowing job creation. The G in GDP stands for gross, but it could just as well stand for gains. And right now, those gains are being privatized by shareholders while the costs and stagnation are being socialized across the labor force. Think about what this means. A portion of the economic growth we're seeing is not coming from a thriving Main Street economy of small businesses hiring people. It's coming from a Wall Street economy where corporate profits are used to boost asset prices rather than wages or employment. This is why you can have a soaring stock market at the same time as a cooling job market. They are feeding each other. Higher profits lead to more buybacks, which push stock prices higher. This makes the economy look incredibly prosperous if your primary measure of prosperity is the S&P 500. But it does virtually nothing for the person whose only asset is their labor. They don't get a cut of the buybacks. They don't see their wages rise when the stock price hits a new high. They are spectators in an economy that is supposedly booming. This creates a dangerous feedback loop, as more economic surplus is directed towards financial engineering and away from productive investment. The real economy, the one of jobs and wages, can stagnate. It's a sugar high for asset owners, but it offers no real nutrition for the rest of the economy. This is the kind of deep dive analysis we do every week in our newsletter. We cut through the headlines to show you the trends that really matter. If you want to stay ahead of the curve and understand the forces shaping your financial future, you can sign up using the link in the description. It's free, and it's the best way to get this kind of insight delivered straight to your inbox. What we've described so far, strong headline GDP, a weak labor market, and high corporate profits, isn't a contradiction. It's evidence that we are no longer living in a single unified economy. We are living in two separate and deeply unequal economies. This is the K-shaped recovery, a concept that has become essential to understanding our current moment. Imagine the letter K. After a crisis, one arm of the K trends upward while the other trends downward. This is a perfect visual for what's happening today. The two arms represent two different Americas, experiencing two completely different economic realities. The top arm of the K is the economy of asset holders. This includes the top 10 to 20% of households who own the vast majority of stocks, bonds, and real estate. For this group, the economy is phenomenal. The stock market, fueled by the corporate profits and buybacks we just discussed, has been strong. Their 401ks and brokerage accounts are flush. Housing prices, while moderating, remain near historic highs, bloating their net worth. This top quintile household is driving a hugely disproportionate amount of economic activity. Analysis consistently shows that the top 20% of earners are responsible for the lion's share of all consumer spending. They are the ones buying new cars, traveling, and spending on services, which keeps that part of the economy humming and props up those GDP numbers. For them, inflation is an annoyance, but it's often absorbed by their rising asset values. Their wealth is growing faster than their cost of living. This is the growth that the headlines celebrate. Then there is the bottom arm of the K. This is the economy of the wage earner. This represents the other 80% of America whose primary source of wealth and security is not a stock portfolio, but a paycheck. And for this group, the story is one of stagnation and struggle. Their experience is defined by the trends we've already covered. Their wages are not keeping up with persistent inflation, meaning they are getting poorer in real terms. The job market, their only path to economic advancement, is freezing up in key sectors. The good paying jobs in areas like tech and business services are disappearing, replaced by a sense of precarity. They don't benefit from stock buybacks. In fact, they are harmed by them, as that money could have been used for wage increases or hiring. For this group, debt is rising. They are increasingly relying on credit cards to cover basic expenses, and the interest on that debt is now sky high thanks to the Federal Reserve's rate hikes. The dream of homeownership feels further away than ever. While the top 20% experience a wealth effect, the bottom 80% experience a debt effect. Their liabilities are growing while their income stagnates. This K shaped reality is the master key to unlocking the great disconnect. When a news anchor says consumer spending is resilient, what they often mean is that wealthy consumer spending is resilient. When a politician says the economy is strong, they are looking at the stock market and the GDP figures being propped up by the top arm of the K. They are missing the story of the bottom arm entirely. They are missing the fact that for the vast majority of people, the economy is defined by a silent recession in the job market and a cost of living crisis that never seems to end. This isn't just an economic issue, it's a social one. It breeds resentment and distrust. When people are told the economy is great, but they feel the exact opposite in their own lives, they rightly conclude that the system is rigged or that the people in charge are completely out of touch. And the data suggests they are not wrong. The system is producing wildly different outcomes depending on whether you own assets or you earn a wage. So, we've laid out the puzzle pieces: strong GDP, a weak job market, high corporate profits, a K shaped divergence. Now it's time to put them all together and expose the fundamental reason for this great economic disconnect. The core reason is this: we are measuring the wrong things, and the things we are measuring are being distorted by a financialized economy that has become detached from the real economy of jobs and production. Our entire public discourse about the economy is anchored to GDP. But what is GDP? Really, it's a measure of spending. That's it. It's a tally of money changing hands. It doesn't tell you who is spending the money or if that spending is creating broad based prosperity. And it doesn't distinguish between productive spending and financial engineering. The growth we see in GDP is increasingly a reflection of activity among the wealthy, not a reflection of a healthy economy for the average person. When a corporation executes a massive stock buyback, it boosts its stock price, creating a wealth effect for its shareholders. Those shareholders, who are overwhelmingly wealthy, then feel richer and spend more money, which boosts GDP. The economy grew, but not a single new job was created in the process. We are witnessing growth that is decoupled from prosperity. Compounding this is the role of the Federal Reserve. To its credit, the Fed is in a tough spot. Its job is to maintain stable prices and achieve maximum employment. For the past few years, it has focused on fighting inflation by aggressively raising interest rates. After holding rates high, they have recently begun to ease them. After a couple of rate cuts in 2025, the target federal funds rate now sits in a range of 3.75% to 4%. But these high rates, while intended to cool inflation, act as a sledgehammer to the labor market. They make it more expensive for businesses to borrow money to expand and hire. This particularly hurts small businesses, which rely on loans to operate and grow, which is a major reason why we saw them shed 120,000 jobs in November. So you have a dynamic where Fed policy is actively slowing down the job market for the bottom 80%, while the top 20% are largely insulated, living off asset gains. The Fed's actions hit the wage-earning economy far harder than the asset-owning economy. This policy, while aimed at fighting inflation, has the unavoidable side effect of deepening the K-shaped divide. Finally, structural changes are happening under the surface. The rise of automation, AI, and increased productivity allows companies to produce more with fewer people. This isn't just a future concept, it's happening now. A company can invest in new software that increases its output without increasing its headcount. The result: GDP goes up, productivity goes up, profits go up, but employment stays flat or even falls. The gains from that productivity are not always shared with labor as higher wages or with the public as more jobs. They are often captured by the corporation and its shareholders. This is the ultimate cause of the disconnect. We have an economy that has been optimized to generate corporate profits and inflate asset prices while treating labor as a cost to be minimized. We measure this system with a blunt instrument called GDP that tells us we're growing when in reality, the vast majority of people are being left behind. So, where does this leave us? The economic picture we've painted is confusing and for many, deeply discouraging. The headlines will continue to blare about GDP growth, while your own experience may be one of financial anxiety. The first and most important takeaway is this: you are not crazy. Your feelings of unease are a rational response to the reality of the K shaped economy. The disconnect you feel is real and it is backed by data. The system is indeed producing wildly different outcomes, and the traditional metrics are failing to capture the whole picture. Understanding this is the first step toward navigating it. It means recognizing that the stock market is not the economy. It means looking past the headline unemployment number and paying attention to the real unemployment rate, the U6. It means understanding that when you hear about growth, you need to ask, growth for whom? On a personal level, this environment requires a defensive financial strategy. In a world where job security is less certain, building an emergency fund, paying down high interest debt, and living below your means are no longer just good advice. They are essential survival tactics. It means being skeptical of narratives that promise easy gains and instead focusing on building a resilient financial foundation. But on a broader level, this disconnect is a challenge to all of us. It forces us to question what kind of economy we want. Do we want an economy measured solely by the wealth of its richest citizens and the profits of its largest corporations? Or do we want an economy that creates broad based prosperity, stable employment, and a sense of security for everyone? The great economic disconnect isn't a temporary blip. It is the result of long term trends and policy choices that have consistently favored capital over labor. Changing course won't be easy. It requires a new way of thinking and a new set of demands from all of us. The most powerful tool you have in this confusing environment is knowledge. By understanding the real mechanics of what's happening, you can protect yourself financially and become a more informed participant in the conversation about our collective future. The story they are telling you is not the full story. Now you know why. Thank you for watching. If you found this analysis valuable, please consider subscribing and hitting the notification bell. And let me know in the comments. Does your personal economic reality match the headlines? Let's talk about it.